Hello students, in this presentation we are going to discuss about Accounting Standard 12, Accounting for Government Grants. The basic function of any good government is promoting economic and industrial development of the country. How does a government do that? It does by enticing companies to underdeveloped areas. And how does it do that? By giving them incentives. Incentives can be in form of tax breaks, like if you see 80IA, 80IB, 80HFC and many such sections under the Income Tax Act. Or it can be in form of grants, like giving grants for investing in fixed assets, giving grants for research and development. So a government takes steps like this to bring companies into underdeveloped areas. This kind of incentive, in which it gives cash grants or kind grants, is known as government grants. Since the government grants are increasing because we are a developed country, it is important to account for such grants in the correct manner. Why do we need Accounting Standard 12? Is because of two reasons. You will see further that there are different kinds of grants. Some are revenue in nature, some are capital in nature, and grants need to be accounted for correctly. Because you need the correct and appropriate method of accounting, you need Accounting Standard 12. Further, users of financial statements must know the extent to which the company has benefited from such grants. Why is this required? Because 1. The user must be able to compare a previous period in which you have not received grant and a current period. Also, the user must be able to analyze what happens if in future you do not receive such grant, whether you will still be able to maintain such profitability or what would be the profitability in such a case. Secondly, the user must be able to compare your financials or the company's financials with another company's financials in a similar industry. For this comparison to happen, users must be provided with proper information. This information, that is what information needs to be provided, is given by Accounting Standard 12. Hence, AS 12 is very important. Let us now discuss the scope of the standard. AS 12 deals with accounting for government grants, which can be either capital grant or revenue grant. But the important thing is it should be received only from government agencies. This means grants received from private agencies or private companies are not covered by Accounting Standard 12. It covers only government agencies, that is grants given by government agencies. Now government agencies cover Indian or domestic agencies, domestic government agencies, and also international government agencies. But it has to be a government agency. It cannot be a private agency. Now grants can be in form of monetary or non-monetary. Monetary grants cover subsidies, cash incentives, duty drawbacks, etc. Non-monetary grants covers lands, plant and machinery, or some other assets or cash or resources. cash is covered by monetary grant, land or other assets or any other resources. So scope of this standard covers any grant received from government agencies, and that grant can be in form of monetary or non-monetary. The standard excludes three things. 1. Accounting for government grants in financial statements reflecting the effects of changing prices. Now, what happens is, in some of the countries, there are standards which guide you on how to prepare financial statements that reflect the effects of changing prices. That is, financial statements are prepared in current cost approach. In India, we generally follow historical cost approach. So, the financial statements which are prepared on current cost approach or which reflects the effects of changing prices, such financial statements, accounting for government grants in such financial statements are not governed by Accounting Standard 12. Secondly, Accounting Standard 12 does not cover any government assistance other than government grants. That is, it does not cover tax holidays, tax exemptions and similar items where it is neither a direct monetary grant nor a non-monetary grant. It is a general grant to overall industry or all the companies. And lastly, it does not cover government participation in ownership of the enterprise. That means it does not cover government buying equity shares or such kind of ownership of an enterprise. It only covers grants given and not the ownership bought by the government. Let us move on to definition of government grant. Government grant is nothing but assistance by government. Assistance by government, whether in cash or in kind, for past or future compliance of certain conditions. That means you have already complied with certain conditions because of which you are getting grants, or there can be a case where you are required to comply with certain conditions, otherwise you will have to refund the grant. However, you can only recognize it if you are reasonably certain that you will fulfill such future conditions. But it is covered in the definition of government grant. Government grant covers assistance by government in cash or kind for past or future compliance of certain conditions. However, it does not include grants which cannot be reasonably measured. That means you should be able to measure the government grant. Secondly, it does not include transactions with government which cannot be distinguished from normal trading transactions of an enterprise. That means some enterprises deals with government, selling goods or services or buying goods or services of the government. Now, a government grant should be clearly distinguished from your normal trading operations. Only if you are able to clearly distinguish it from your normal trading transactions, you should recognize government grants. And only if you are able to reasonably measure government grants should you recognize them. Okay, government includes union government, state government, government agencies and similar bodies, whether local, national or international. The standard prescribes two methods of accounting: capital approach and revenue approach. Okay, capital approach says grant should be treated as part of shareholders' funds, whereas income or revenue approach says that grant should be taken to income statement, that is your profit and loss account, over one or more periods. Which approach you follow depends upon the nature of the grant. Some grants you follow capital approach, some grants you follow income approach. We will in future slides learn where to follow capital approach and what is capital approach. Similarly, we will also learn where to follow income approach and how to follow income approach, or what should be accounted for in income statement approach. Capital approach. Sometimes governments announce, say state government announces that if a company establishes any factory in this particular area, will be granted say 1 crore rupees cash, or will be given discounts, or will be given cash subsidies if 100 crore rupees is invested in this particular area. Similar schemes where it is related to promoters' contribution, to reduce promoters' contribution, to entice them to come to this particular area, falls under the capital approach. Let us read it now. Many government grants are in nature of promoters' contribution. That is, they are given with reference to total investment in the undertaking, factory, business, or by way of contribution towards a total capital outlay. Total capital outlay means total capital investment, and no repayment is ordinarily expected in the case of such grants. These should be credited directly to shareholders' funds. For example, proportion of total investment in business. As I said, if you invest 100 crores, you get 1 crore or 2 crores, something like this, where it is proportion of your total investment. Second example is related to specific fixed assets. So if your plant and machine, let us take the first example, that is grants in nature of promoters' contribution, where the government grants are of the nature of promoters' contribution, that is, they are given with reference to total investment or total outlay in an undertaking, or by way of contribution towards its total capital outlay. For example, Central Investment Subsidy Scheme. That is, this is a subsidy scheme of central, that is not state, central government. And no repayment is ordinarily expected in respect thereof. The grants, such grants are treated as capital reserve, which can be neither distributed as dividends, nor it can be considered as deferred income. Second transaction, or another transaction where capital approach is followed, is where grants are related to specific fixed assets. Grants which are related to specific fixed assets are grants where primary condition is that enterprise qualifying for them should either purchase, construct, or otherwise acquire such assets. Other condition that may be attached restricting the type or location of assets or the periods during which they are to be acquired or held. That means, say, suppose you have to invest in a hotel between 2012 to 2016. So you are restricting the type of asset or location of the asset or period during which they are to be acquired or held. Now, grants involving or related to specific fixed assets can be accounted in two different methods. One way of accounting is you reduce the cost of fixed assets, and hence you reduce the depreciation on those fixed assets. Other way is to treat the grants as deferred income and taken to P&L over different periods. So every year you take some portion of it to profit and loss account. We will discuss both the methods in following slides. Method 1. In the first method, whatever grant you received for specific fixed asset must be reduced from the gross value of the asset concerned in arriving at its book value. That means you should reduce the grant received from the cost. For example, the asset costed 10 lakh rupees and you received 2 lakh rupees as grant. So your book value should appear at 10 lakhs minus 2 lakhs, which is 8 lakh rupees. The grant is thus recognized in profit and loss statement over the useful life of depreciable asset by way of reduced depreciation charge. That means now you will depreciate on the 8 lakh rupees. Hence, the 2 lakh depreciation on the 2 lakh rupees is not charged to P&L. That is, it is taken over P&L over the different periods in form of reduced depreciation charge, where the grant equals whole or virtually the whole of the cost of the asset. That means you have received the asset for free. That means, say the asset cost 10 lakh rupees and you have received entire 10 lakh rupees as grant from the government. The asset is shown in the balance sheet at nominal value, which is say 1 rupee. Let us now move on to an example where we will understand how to apply the method 1. Say Z Limited purchased a fixed asset for rupees 50 lakhs, which has estimated useful life of 5 years with salvage value of 5 lakhs, and say you are following straight line method of depreciation. Hence, your depreciation charge would be cost minus salvage value divided by useful life, which is 50 lakhs minus 5 lakhs divided by 5 years, which comes to 9 lakhs per year. However, on purchase of asset, you received a government grant, or Z Limited received a government grant of 10 lakh rupees. Now, your cost becomes 50 lakh minus 10 lakh, which is 40 lakh rupees. Let us see what would be the journal entries in this example. Firstly, you will record the purchase of asset, which is fixed asset account debit to bank account 50 lakh rupees. Now, you have received a grant of 10 lakhs, which you are supposed to reduce from the cost of the asset. Hence, the entry will be bank account debit to fixed asset account, which is 10 lakh rupees. Now your cost of asset becomes 40 lakh rupees. Salvage value remains the same, useful life remains the same, so your depreciation becomes 50 lakh minus 10 lakh, that is 40 lakhs, minus salvage value of 5 lakhs divided by 5 years, which is 35 lakhs divided by 5 years, which is 7 lakh rupees, for which you will pass a journal entry, depreciation account debit to fixed asset account 7 lakh rupees. Students, you saw that in method 1 we reduced the cost of the fixed asset by the grant received and thereby reducing the depreciation charge to the profit and loss account over the period. Hence, grant is taken to P&L indirectly by reducing depreciation charge. In the second method, you will see that the grant is not reduced from the cost of the asset. Instead, it is shown as deferred income. This deferred income is generally taken to P&L in proportion of depreciation charged on that fixed asset. Let us read it, understand it, and then we'll move on to an example which will explain you how to take care of this method too. What journal entries do we pass? Okay. Grants related to depreciable assets are treated as deferred income, which is recognized in profit and loss statement on a systematic and rational basis over the useful life of the asset. This systematic and rational basis, students, is proportion in which depreciation is charged. Whereas grants related to non-depreciable assets, the assets which are not depreciated, for example land. Since land is not depreciated, you cannot take the deferred income to the profit and loss account, because you would have taken it in proportion of depreciation, no charge to profit and loss. Hence, such grants which relate to non-depreciable assets are credited directly to capital reserve. Now, if a grant which is related to non-depreciable assets requires fulfillment of certain conditions, certain obligations, then this grant is taken to P&L over the same period over which cost of meeting such expenses is charged to income statement. That means, say suppose government gives you a land at subsidized rates. So land costing 1 crore is given to you for 25 lakhs. That means at 75% discount. However, you have to incur certain expenses on, say, research and development. Now, say you have to incur 50 lakh rupees on research and development over the 3 years. Then this 75 lakhs which you have received as grant should be taken to P&L over the period of 3 years in the proportion to which you are incurring this research and development expenditure. And lastly, the deferred income is suitably disclosed in balance sheet pending its appropriate apportionment to profit and loss account. That means this unamortized deferred income, the deferred income which is not yet taken to P&L, is disclosed in balance sheet till the time it is taken to P&L. Let us take an example to understand this method. Say Z Limited purchased a fixed asset for 50 lakh rupees, which has estimated useful life of 5 years with a salvage value of 5 lakhs. This is the same example which you considered for method 1. We will now see what happens in method 2. Government grant received 10 lakh rupees. Cost of fixed asset 50 lakhs. Useful life 5 years, salvage value 5 lakhs. Here we are not going to reduce the cost of fixed assets. That means fixed assets will remain at 50 lakhs. The depreciation on this fixed asset will be 50 lakhs minus 5 lakhs salvage value divided by 5 years, which is 9 lakhs per annum. Depreciation will be 9 lakhs per annum. 10 lakhs government grant which you have received will be shown as deferred income. Now, since we are following straight line method of depreciation, charge to P&L will be same every year. Hence, 10 lakh rupees government grant is also taken to profit and loss account equally over 5 years, which is 2 lakhs per year. Let us see the journal entries. So students, first you record the fixed asset purchased, which is fixed assets account debit to bank account, rupees 50 lakhs. Next, you record the government grant received, which is bank account debit to deferred government grant account, rupees 10 lakhs. If you see here, we have not credited the fixed assets account. We have credited a different account, deferred government grant account. Now, depreciation, as I said, will be 9 lakh rupees, which will be normally charged to P&L. Depreciation account debit to fixed assets account, rupees 9 lakhs. Now, deferred government grant which we calculated as 2 lakhs should be credited to profit and loss account every year. Deferred government grant account debit 2 lakhs to profit and loss account. This is how over the period of 5 years you will credit income statement by 2 lakhs every year, totaling 10 lakhs. This is how government grant, deferred government grant is taken to profit and loss account. This is the method 2 of accounting for grants relating to specific fixed assets. Students, we learned that capital grant can be of 2 types. One, which is similar to promoter's contribution, wherein it is dependent upon the total outlay or total investment and not to specific fixed assets, and hence they are taken to capital reserve account. Second method of capital grant is where you receive grants related to specific fixed assets. Now, any other grant which is neither related to total investment nor related to specific fixed assets is treated in income statement approach or by way of income approach. Now, where you follow income approach, the grants received should be taken to income statement and it should be matched or in a manner in which associated cost which relate to the grant is intended to compensate. This means, say if you have received certain grants for incurring certain research and development expenditure, that means say state government or central government announces that if you incur 100 rupees on research and development, government will pay you 25 rupees in cash. Now, this type of government grant is directly related to your incurring of expenses. So if I incur 100 crores rupees on research and development in a particular year, government will give me 25 crore rupees. So 100 crore goes to P&L expense, 25 crore will go to P&L income in the same proportion to which the costs are associated, or the government grant is intended to compensate certain expenditure. That expenditure goes to P&L, same manner government grant goes to P&L. Now, you can record government grant in P&L in 2 ways. One method is grants related to revenue are presented as credit in profit and loss account, either separately, that means separately showing as government grant related to research and development expenditure, or under a general heading of other income. That means you can show it either as a credit in profit and loss account, or alternatively they can be deducted from related expenditure. That means instead of showing my research expenses as 100 crores, I reduce 25 crores from 100 crores and show my research expenses only as 75 crores. I have 2 options for income approach. Income approach is anything other than grants given for total investment or grants given related to specific fixed assets. Let us now go on to a summary chart which will explain you in summary whatever we have discussed till now. Students, this chart will explain you in summary how to account for government grants. As we discussed, government grants can be of 2 types: capital grant or revenue grant. Capital grant can be related to fixed assets or for capital contribution, which is related to total investment, total outlay for your business. Now, if it relates to fixed assets, it can be either a cash grant or grants in kind. Now, if If you receive cash grants, you have two options. One, you reduce from the cost of fixed assets and hence your depreciation will reduce, or you show it as deferred income, deferred credit, and take it to profit and loss account in a manner or proportionately to your depreciation expense. Secondly, fixed assets can be received in kind. That means where the grants approximately equal or almost equal to your total cost. In this case, you should account for fixed assets at nominal value, which is rupee 1. Now, capital grants can also relate to, as we discussed, promoter's contribution or capital contribution or total outlay. Whereas, see, we have discussed in the scope of the standard that it does not cover buying of shares or buying of basically investing in a company. Government should not be investing in that company. However, if the grant is given in proportion to total investment, government is not getting promoter contribution. That means government is not being a promoter of the company or not investing in the company. Government is giving grants to the company in relation to total investment in cash. Such grants should be recorded in capital reserve and should not be taken to P&L at all. Fine? Okay. Now, some grants are revenue in nature. That means which are not related to fixed assets and not related to capital contribution are called as revenue grants. Revenue grants can be recorded in P&L in two ways. One, as other income, or two, as deduction from the respective expenditure. This chart explains in summary the entire standard which we have discussed till now. Let us now move on to the next part. Students, as we said, government grants are sometimes received along with certain conditions which are required to be fulfilled. Sometimes companies are not able to fulfill certain conditions, because of which they have to refund some portion or entirely the government grants that they have received. Such a case is treated as extraordinary item under Accounting Standard 5, prior period and extraordinary items and changes in accounting policies. When you do that standard, you will be able to further throw light on this. Now, we will discuss how should a refund of government grant be treated in books of accounts. As we said, government grants can be either revenue grant or it can be capital grant. In case the grant is revenue grant and it is not taken to P&L in the same year, it relates to future periods as well. In that case, there can be some unamortized deferred income standing in your balance sheet. Firstly, amount refundable should be adjusted with the unamortized credit standing in the balance sheet. If there is still balance which needs to be refunded, then that should be immediately charged to profit and loss account. Let me give you an example. You received 10 lakh rupees grant from the government, which you plan to take it to P&L over 5 years, 2 lakh rupees per annum. Now, after second year, where you have already taken 4 lakh rupees to P&L and 6 lakh rupees stands in the balance sheet. Government says that you have to refund me 8 lakh rupees because you are not able to fulfill the conditions. Now, you have 6 lakh rupees standing in the balance sheet. So first you adjust 6 lakhs with the balance sheet and make it 0. Balance 2 lakhs, that is 8 lakhs minus 6 lakhs. 2 lakhs is charged to the profit and loss account. That is how you treat refund of government grant where it is revenue grant. In future slides, we will discuss what happens when the grant relates to specific fixed assets and when the grant relates to promoter's contribution. Where the grant relates to specific fixed assets and now you have to refund it. If you remember, you had two ways of accounting for grants related to specific fixed assets. One is where you reduce the cost of fixed assets. Now, if you had previously reduced the cost of fixed assets, when you are refunding the grant, you increase the cost of fixed assets by that amount. Now, if you had not reduced the cost of fixed assets, but you had shown it as deferred income, in that case, you first adjust the deferred income, and if any balance exists, then you take that balance or charge it immediately to profit and loss account. For example, if you had received 10 lakh rupees as grant, in first method you had reduced it from the fixed assets, cost of fixed assets. Now if the government asks you to refund 8 lakh rupees, you will increase the cost of fixed assets by 8 lakh rupees and depreciate on the higher amount. This depreciation will be charged or calculated prospectively. Prospectively means from now on, here on, you will revise the depreciation charge. Second method, where you had credited to deferred income instead of reducing the cost of fixed assets, and say by second year you had already taken 4 lakhs to P&L. You have 6 lakhs standing in deferred credit. You will now charge that 6 lakhs. First of all, reduce that 6 lakhs to 0 and balance 2 lakhs. That is 8 lakhs minus 6 lakhs. 2 lakhs will be charged to profit and loss immediately. This is how you take care of grants that relate to specific fixed assets. Let us read it. The amount refundable in respect of government grant related to specific fixed assets is recorded by, in the method 1, you increase the book value of asset. In the method 2, you reduce the capital reserve or the deferred income balance by the amount refundable. Now, in the first alternative, where the book value of asset is increased, the depreciation on the revised book value is provided prospectively over the residual useful life of the asset. As I said, you recalculate the depreciation here on from that date onwards. Next slide will explain how should you treat refund of government grant where it relates to promoter's contribution. Students, where we had received government grant in relation to capital contribution or promoter's contribution, we had taken the amount to capital reserve. Where you had taken the amount to capital reserve and you are now to refund the capital grant or the government grant, you will reduce the capital reserve or you will adjust the amount with the capital reserve. Where a grant which is nature of promoter's contribution becomes refundable in part or in full to the government or on non-fulfillment of certain specified conditions, the relevant amount recoverable by grant is reduced from capital reserve. Now, let us take an example and try to understand the journal entries which you will book in case of refund of government grant. Students, let us take the same example where Z Limited purchased an asset of 50 lakhs having salvage value of 5 lakhs and useful life of 5 years, where government grant received was rupees 10 lakhs. Now, say suppose in the second year, at the end of second year, you are to refund the grant worth 7 lakh rupees. Let us take method 1 and method 2 and understand what happens in both the methods in case of refund of government grants. In method 1, what you had done was you had reduced the cost of fixed assets by 10 lakh rupees and you were providing depreciation on the reduced cost. Now when you are refunding 7 lakh rupees, you will increase the cost of fixed assets by providing a journal entry, fixed asset account debit to bank account. So now let us imagine the journal entries which you would have booked till now. Firstly, you had booked a fixed asset worth 50 lakh rupees, then you had reduced it by 10 lakhs, so your cost of fixed asset had become 40 lakhs. Then you had provided depreciation of 7 lakh rupees first year, second year. So your cost, your reduced WDV had become 40 lakhs minus 7 lakhs minus 7 lakhs, which is 26 lakhs. When you increase the cost by 7 lakhs now, the cost becomes 33 lakhs. WDV becomes 33 lakhs. From here on, remaining 3 years, you will provide depreciation on 33 lakhs. 33 lakhs for next 3 years. Okay. Now let us understand what will happen in method 2. In method 2, we had, instead of reducing it from fixed assets, cost of fixed assets, we had shown it as credit or deferred income. Deferred credit or deferred income. Now, first 2 years we had discussed that first you had created fixed assets of 50 lakhs, you had depreciated by 9 lakhs per annum. So your WDV would have become 50 lakhs minus 9 lakhs minus 9 lakhs, which comes to 32 lakhs. On the other hand, deferred credit, we were taking to P&L 2 lakhs per annum. So your deferred credit balance in balance sheet would have become 10 lakhs minus 2 lakhs minus 2 lakhs, which is 6 lakhs. So now you have 6 lakhs standing in deferred credit and 32 lakhs standing in the fixed assets. If you see now, we have to refund 7 lakh rupees. Standard says first you adjust the deferred credit. Deferred credit is only 6 lakhs. You have to refund 7 lakhs, so you are short by 1 lakh rupees. This 1 lakh rupee will be charged to profit and loss account. So your journal entry will be deferred government grant account 6 lakhs, profit and loss account 1 lakh, to bank account 7 lakh. This explains the entire refund of government grant in case of specific fixed assets. The next slide we will discuss in summary what will happen in refund of government grant in each of the case which we have discussed till now. Students, this chart summarizes the entire refund which we have, accounting for refund which we have discussed till now. As we discussed, refund of government grant can relate to asset or capital contribution, or it can relate to revenue. In case of asset, you have two options. One, if you have reduced from cost, or if you have credited to deferred income. Now, if you had earlier reduced from cost, you will now increase the cost. That means you will add to the cost the refund amount, and depreciation will be calculated prospectively. If you had earlier treated it as deferred income, then now first you will adjust the unamortized deferred credit. Balance you will take it to profit and loss account. Now in case of non-depreciable fixed assets like land, or in case of capital contribution or promoter's contribution grant, where you credited it to capital reserve, in that case you will adjust the amount with capital reserve. In case of grants which are revenue in nature, you would have taken the grant to first unamortized deferred credit, and from there you would have charged to or booked as income in profit and loss account on a systematic basis. When you refund the amount, you first adjust it with unamortized balance in deferred credit account. If any balance remains, that means deferred credit account is not enough to adjust the entire refund, the balance will be taken to profit and loss account. This in all summarizes the total accounting for refund of government grant. Students, till now we have learned how to account for government grants received and how to account for refund of such government grants. However, you should account or recognize a government grant only and only when two conditions are fulfilled. These are: 1. It is reasonably assured, or there is reasonable assurance that the enterprise will comply with the conditions attached to the grant. Secondly, you are reasonably certain that you will be able to ultimately collect the amount of the grant. Only when these two conditions are fulfilled should we recognize government grant. 1. That you are reasonably assured that all the conditions will be fulfilled. That is, you unnecessarily do not want to account for a government grant and then account for a refund. Instead, unless you are reasonably assured that the conditions will be fulfilled, you should not at all account for government grant. Only when you are reasonably assured, you should account for government grant. Secondly, you should also be reasonably certain that government will give you the grant promised. Only when you are reasonably certain that you will receive the grant promised by the government, that is ultimate collection will be made, should you recognize the government grant. Else you should not recognize the government grant. Please note that a mere receipt of a grant is not necessarily a conclusive evidence that conditions attached to the grant have been fulfilled or will be fulfilled in future. It is not a conclusive evidence just because you have received the grant. You should have reasonable assurance that conditions will be fulfilled. Then and only then should you recognize government grant. Lastly, students, the standard prescribes disclosure requirement so that users of the financial statements understand the entire accounting or entire transaction of government grant. Firstly, you need to disclose the approach which you have followed. That means whether you have followed a capital approach or a revenue approach. That means whether you have reduced from fixed asset and or you have shown it as deferred credit, or you have shown it as capital reserve, or whether you have followed a revenue approach where you take it to profit and loss account. Then you have to disclose the method of accounting followed within the capital approach or within the revenue approach. That is, as we discussed, whether you have reduced from cost or you have followed capital reserve. Then you have to disclose the nature of the government grant. What kind of government grant you have received. If it is with respect to specific fixed asset, what fixed asset. Then you have to disclose extent to which you have recognized. That means, say you are recognizing 20% every year, or you have recognized 2 lakhs out of 10 lakhs. So extent to which you have recognized, nature of the government grant. Then you have to disclose non-monetary grants if you have received at concessional rate or free of cost. You have to disclose that separately. And lastly, you have to disclose a description of grant. If you have refunded any grant during the year, you have to give description as to why you have refunded, what you have refunded, which condition you could not follow, a general description of the refund along with the financial impact.